Yo, what's up, guys? It's your boy Looney. Today, I want to talk about what I call the lazy investing strategy and how it actually beats 90% of traders trying to time every market move. And no, it's not about chasing hype or sitting in front of charts all day. We're going to talk about using index funds, dollar cost averaging, and selling low delta options to grow your account without losing your sanity. But before we dive in, quick shout out to the Discord. It is free to join, and I also offer a premium membership for $8 a month that gives you access to one-on-one coaching, trade callouts, my full option selling course, giveaways, and more. All the links are in the description. So let's get one thing straight. Being lazy doesn't mean doing nothing. And that's the truth about lazy investing. It means you build a system that works for you so you don't have to constantly think about it. And most traders burn themselves out chasing quick profits. They overtrade and they try to predict every move, and 90% of them underperform the market. Meanwhile, the so-called lazy investor who just stays consistent usually wins over the long term. And that's because compounding doesn't care about effort, it always rewards discipline. So let's start with the first strategy. And this is one I don't necessarily use in this account, but it's very beginner friendly and it's a good starting point for many new investors. And it's very simple. Own the market. And the way to own the market is to buy index funds. And index funds are essentially a bunch of companies wrapped into one position. This way you get exposure to hundreds of strong companies. And this includes companies like NVIDIA, Apple, Amazon, and Microsoft all in one basket. You're not betting on one company, you're betting on the entire economy. And if we just go back to that saying that the S&P 500 has averaged around 10% yearly growth over the long run. So just by staying consistent and staying invested, you're actually already outperforming most traders who try to outsmart the market. Now, again, I don't do this too much. I have it in my account just to kind of benchmark to see how I'm doing against the market. And since I've stopped, or since I've been invested into SPY and VOO, I've actually outperformed. I'm up 63%, and my portfolio is a lot more volatile than ETFs, but it is good to actually compare the two just to see where I'm at and to see where the entire market is. Now, SPY, I only own like one share. I do have dividends collecting, so I could build that over time. And VOO, I also have that same setup. And I used to do dollar cost average, and that's what we're going to get into the next point, but I have it just sitting here. So good strategy, very easy for beginners. If you don't know where to start, that is a good starting point. I wouldn't be doing too many ETFs because a lot of times they overlap. VOO and SPY actually do overlap, and I might actually think of getting out of one of them. But if we look at the top holdings, you have NVIDIA, Microsoft, Apple right here. And then if we go to the SPY on the top 10 holdings, it looks very similar. We have NVIDIA, Microsoft, Apple. So be careful with choosing ETFs. There's a chance they overlap. So I wouldn't do too many of them. I would choose the strong ones, SPY, VOO, or QQQ, and then just stop there. I wouldn't go too much diversified with those because they're already diversified in themselves. Now, the second one I want to go over, the second strategy, is dollar cost average. Dollar cost averaging is a very consistent strategy that I have been using on safe assets as well as risky assets. And it's kept me consistent, it's kept me invested, and it's helped me in the long run with emotional investing. And it's very simple. You pick a set amount, whatever it is, $10, $50, $1 a day. So let's actually pull up Hood because that is what I do. And you just invest it automatically no matter what. So when the price dips, you buy more. When the price rises, you buy. Yes, you can change it up a little bit. When the price is actually low, you buy a little bit more. Like you don't just do the automation, you actually buy out of your own pocket. And then when it goes higher, you just keep to your dollar cost average. And by doing this, you remove the emotion and avoid the trap of trying to time the perfect entry. And this is the foundation of the lazy investor mindset. It's that consistency is better than perfection. And not only do I do it with stocks, but I also do it with crypto. So Bitcoin, and I have taken profits, so I will keep that a note as to why my position is almost 2,000 now, but it probably would be a lot more if I didn't sell or take profits. But moving forward, I'll probably just keep holding my Bitcoin, even if it does dip further lower. But with this, I'm actually putting $3 a day. And crypto, if you don't know, is 24 hours. So even weekends, I am invested. And I'm just building this position. And yes, I'm only at 40%, but I have taken profits. That's why it has changed. But you can see how much this is built up. And I'm just going to keep letting this run, keep letting it do its thing, and keep stacking my position. And it's very lazy. I don't have to worry about what Bitcoin is doing. Yes, today it was down 1.84%, but honestly, I don't really care. I got it for cheaper. If you look at my price, my buy-in price, we go down here and market buy was filled, and it was filled at 123,000. And if we go up to here, it is 122,000. You do have to keep in mind that they do some exchange rates, but earlier today it was at 125. So I actually got it for a better price than what it was initially trading at. And this is a very easy strategy. You don't have to do much thinking. You just let it go and you let it run for however you want to do it. I don't plan to sell my Bitcoin anytime near. And yeah, I might never sell it, but who knows? Now, the last strategy, and I don't know if it's more advanced, but it involves option trading. And that is selling low delta options for passive income. Now, once your portfolio grows a little, that's when you can add one of my favorite income strategies, and that is selling low delta options. And here's what it means in simple terms. Delta actually measures how likely an option is to end up in the money. Low delta, around 0.1 to 0.2, means it has a low probability of being hit, but you could actually still collect a premium upfront for selling it. And the way to think of it is like you're selling insurance. You're selling contracts that probably won't be what they call exercised, and you're getting paid for taking that risk, exercised or even assigned. So let's actually look at an example. I'm going to use TSLL. It is a leverage ETF, and it is a risky asset. But with risky assets like this, you could actually choose really low delta. When I first did this, delta was at 0.11, I believe, or somewhere around there. And it's basically trading at the same right now, which is okay. And I collected $26 for this option strategy. And just collecting $26 in a week or in a month is actually a really good return. And you could actually reinvest those into other positions. And that's how compounding works. And if you want to be very safe, you choose low deltas. And if you're using margin, you could even choose lower delta. I'm not using margin. I am looking at this leverage ETF, which kind of allows you to go lower deltas, but because of how risky it is. If you know how leverage ETFs work, is they're very risky. And this one, for example, was down 8%. But again, I'm not concerned. This is a very easy strategy or passive strategy that I could keep under control. If I get assigned at $12, I'm perfectly okay with owning it at a discount. And yes, you could use this strategy with individual stocks. I have one going on Zeta. This one, I chose a little bit higher delta, but you can see here it's at 0.14, and I'm letting Theta do its thing. And Theta is basically time decay, and it works for you instead of against you, whereas buying options where you're chasing those 1,000% returns, data or time actually works against you. Whereas selling options is just small, consistent income that adds up. Because you can see $45 here, $26 there. It adds up over time, and it allows you to be more flexible. And that's what I'm doing week after week, month after month, selling options, dollar cost averaging. And you could actually combine dollar cost averaging with selling options. If the stock drops lower and lower, you could keep selling puts at lower strike prices. And of course, you do need the capital to do that. You could even mix in credit spreads, which act very similar, but their risk they're riskier, and also they're defined risk. So you might use less capital, but you don't win as much. And once you get assigned with cash secured puts, you could actually sell covered calls and own the shares. Whereas credit spreads, you either win or lose a trade. So choose from that. I personally like selling options one legs at a time, and then if I want to, I'll mix in some credit spreads. But just to wrap things up, the lazy investing strategy that beats 90% of traders comes down to 3 simple steps. One is to own the market with index funds like SPY or VOO. Number 2 is automate your investing through dollar cost averaging to remove emotion. And number 3 is to sell low delta options to collect steady income with limited risk. You don't need to check charts every 5 minutes. You don't need to predict what's next. You just need a system and the patience to stick with it. And actually, sometimes doing less really is the smartest move. Until next time, peace.